Thank you, Adrian, for your insight and fantastic presentation. And now I would like to introduce Lisa Davis, CEO of PearTree, who will be doing a presentation on flow-through, a very important topic right now for our exploration groups. PearTree has been a long-time sponsor and supporter and ally of the event, and we are thankful for their continued support. After Lisa's presentation, she will continue on stage to moderate the morning session. Please help me welcome Lisa Davis to the stage.
Thank you, Joanne, and congratulations on another great year. I think the conference is getting bigger and better as we go. So it's been a busy year and actually an exciting time for those of us that work in the flow-through space. It's exciting that we have a newly elected government that seems to be very supportive of resource projects. There are obviously a lot of hurdles to overcome, but it's definitely the case that Canada's position as a leading mining jurisdiction can in large part be credited to the flow-through share regime. This is, of course, our mandatory disclaimer, which I'll let you read at your leisure for just a second. So what I'd like to talk about today quickly is sort of a snapshot of where the flow-through market stands, but I'd like to focus on some developments that have occurred during the year that are still sort of developing as we speak, but in particular, there's been some changes federally to what may be qualified as Canadian exploration expenses for flow-through share purposes. And the 2025 Quebec budget that was released very recently has some significant implications for financing Quebec projects. Before I go on, just a few bits of information about PearTree. You can read what's on the screen yourself, but I think it's important moving forward and looking at how much change we're seeing legislatively and judicially, how technically tricky this area can be when it comes to charity flow-through or structured flow-through financing, and how the significant experience that PearTree has, having been around since the very beginning, and with a convergence of skill sets ranging from geologists to CFAs to lawyers to tax experts. I mean, we really can sort through all of the chatter and help issuers come up with the best possible financing terms. I don't think too many people here would be unfamiliar with how charity flow-through works, but just as a quick recap and an example, what you see on your screen is just the structure of a charity flow-through financing with an example based on shares of an issuer trading at $1. In this particular case, this would be an issuer that could access the National Critical Minerals Exploration Tax Credit. The issuer would issue shares at a premium of about 30 cents, so $1.30 issuance. Those shares are then immediately donated to charity by the subscribing donor. The charity would be able to sell those shares at a discount to market to an interested institutional or strategic global investor. That could be done at about a 15% premium. So you can see that with shares trading in the market at $1, the issuer minimizes dilution and hopefully can attract an end buyer where there might have been some valuation gap in, particularly dealing with strategic investors that would be attractive to have on your register. So getting on to some of the tricky things in terms of where we are today and changes. What you see up on the screen is a depiction of the critical and strategic minerals in Canada and Quebec. So we've got sort of overlays between jurisdictions and also in terms of categories and what the implications are for what category that you fall into. The federal government, NRCan, has identified a group of critical minerals, which you see on the screen. On top of that, federally, CRA has identified a group, a subset of those, about half or a little bit less of those, which are eligible for the critical minerals exploration tax credit of 30%. And Quebec recently in their budget identified a set of critical and strategic minerals which aren't exactly the same. Those are the ones that are in bold print, whereas Canada's critical minerals are highlighted in yellow. And for Quebec purposes, those critical and strategic minerals attract a 45% provincial tax credit. The other thing that's become a little bit complicated is that if you go back to basics to be able to access the flow-through share regime, the proceeds of a flow-through share offering have to be used to explore what's defined as a mineral resource in the Income Tax Act. Usually that's not a big issue. A base or precious metal deposit is a mineral resource by definition. And then there's a few others where the principal mineral extracted is specifically identified in the Income Tax Act, like diamonds, for instance. However, in certain cases, it's necessary to get a certification from NRCan for the mineral that you're exploring to be eligible for the federal, well, to be eligible at all as flow-through. So like a recent example we came across with exploration for niobium, NRCan has said, well, it might, if it's a monometallic ore deposit, fit within the definition of a mineral resource. But if it's a complex system that contains other elements, you may have to get certification from NRCan. So just a little word of warning there that some of these things are not as simple as they might be, especially with some newer or critical minerals. So just quickly, I think I've shown this slide in presentations here before. It's been updated a little bit, but based on the exploration expenditure data that's been compiled by NRCan, we know that about half of all exploration in Canada is funded by the proceeds of flow-through shares. On top of that, of the flow-through share financings that are done in Canada on Canadian exchanges, the majority of those funds are raised via structured or charity flow-through offerings, with the trend being that about 3/4 of those deals are done as structured transactions. So we've seen this ongoing, consistent trend where the traditional flow-through financings are a smaller minority of where the funds are coming from. The other consistent trend that we're seeing, and this data is a little bit out of date, but it's the most recent available information from Statistics Canada, which was 2022, is about 90% of all flow-through financing comes from a very small number of taxpayers, about 13,000, who are in a high earning category of $250,000 or more. What's important about that, and these are one of the changes that we're watching for to see how they evolve over the next little while, is that high-income earners can be subject to alternative minimum tax, which is basically a parallel tax calculation that removes certain credits and deductions to ensure that those taxpayers pay at least a minimum amount of tax each year. And there were some changes that were announced, and some of which were implemented in legislation going back to 2023 and 2024. some of those deny some of the credits, both for CEE deductions and for charitable contributions, which combine to create the result that you need a lot more income to acquire the same amount of flow through without having to pay alternative minimum tax. There was an announcement in August of 2024 by the Department of Finance to amend the AMT rules that would be much more favorable for flow-through financing. Of course, with Parliament being prorogued and elections and what have you, the end of that story is yet to be written, so we're watching that closely. So just moving on in terms of recent changes, we're happy to see that the Liberal platform plans to expand qualifying minerals for the critical minerals exploration tax credit purpose to include a wider group necessary for defense, semiconductors, energy, and other clean technologies. More I think exciting in some ways is an issue that's been plaguing the industry for a long time, which is the view of CRA with respect to what can qualify as Canadian exploration expense, the expenses that you can use the proceeds of flow-through financings to fund. That definition is determined based on a purpose test, so the expenses have to be incurred for the purpose of determining the existence, location, extent, or quality of a mineral resource. And CRA traditionally has taken quite a narrow view of what particularly quality of a mineral resource means, and have always said that that's limited to the physical characteristics of the mineral. And they've also taken somewhat of a temporal view of the mining exploration sequence, thinking that it sort of stops. There's like a bright line and your exploration purpose ends at a certain point. So just a couple of months ago, the Supreme Court of British Columbia, in a case involving Seabridge Gold, came out with a decision, and I really applaud Seabridge Gold for going the distance with this, because one of the problems with the way CRA audits is that they base most of their auditing on administrative positions that have no foundation in judicial law, because there just haven't been decisions. It's obviously very expensive, and most junior companies don't have the resources to go to court over these things. But the Supreme Court of British Columbia came out with their decision in that case, and what it held was that the term quality includes a whole range of economic and operational factors that are necessary to assess the economic viability of a mine, and you can't just look at exploration without viewing it in the context of doing that exploration for the purpose of determining if that mineral resource can be mined profitably. So the court allowed a bunch of expenses that were denied by CRA, including expenses for engineering services that made recommendations for mine design, and those related to water management, tailings control, all kinds of capital and mine operating cost estimates, and even capital and operating costs in relation to processing. So it was a really good thing for the industry. There's still a portion of that is being addressed with CRA, so again, the end of that story hasn't been written, but I think still really important. Finally, I think that, well, the time has passed for an appeal, so again, there's a little bit more to come. I am running out of time, so I just want to quickly say that in the Quebec budget, there were some changes where the Quebec removed certain additional tax benefits that were available when Quebec subscribers for flow-through shares invested in a Quebec project. They have increased their tax credits for corporations, but decreased the ones for for non-precious metals, so the critical mineral credits have been increased. One other positive is that these tax credits are accessible for development expenses, so that's new. They have a limit of $100 million over 5 years, but there's a lot of changes in Quebec and a lot of implications in terms of how you would structure a transaction for a Quebec project now. I would just say that if you have any questions, please feel free to contact myself or any of my team whose information is up there. Thank you very much.